Hello everyone, this is Mr. Lipchick and we're going to talk a little bit today about monetary policy, which is different from fiscal policy. Please do not confuse those two things. We're going to talk about its influence on the economy. Okay, first we'll talk about the money creation process. The money creation process is a tool of monetary policy. Money creation is the process by which money enters into circulation in the economy. And no, it is not magic. It actually is a process which is controlled by the government and banks and individual lenders and borrowers. Okay, so how does this money creation process work? Banks create money through the lending process. When a bank receives a deposit, it doesn't keep all of the money, but it lends it to businesses and other customers. The bank is required to keep a portion of the deposit on hand, which is determined by the required reserve ratio, which is set by the Fed, which is short for Federal Reserve System. The bank customers who receive portions of the deposit in the form of loans also make bank deposits, which in turn are partially loaned out, with the RRR being kept by the bank, okay, the required reserve ratio. And as a result of this process, more money enters into circulation and the economy grows. Okay, the amount of money that is actually created by a banking deposit is determined by using the money multiplier formula, which is equal to 1 over the required reserve ratio. For example, a $1,000 deposit is made when the required reserve ratio is 10%, which gives you 1,000 times 1/10 equals $100, which must be kept in reserve. Let's say that $900 of the deposit is then lent to another customer, and again the required reserve ratio of 10% is applied, so that 90% must be kept in reserve. And $810 of this deposit is then lent to another customer who deposits it. And at this point in time, the money supply is increased by $2,710. 1,000 plus 900 plus 810. Okay. And there are numerous tools that the federal government uses to adjust the money supply, apart from just cranking out dollar bills. The Fed has 3 basic tools which it uses to control the supply of money. One is adjusting the required reserve ratio, which we just discussed. 2 is changing the discount rate. And 3, open market operations. And we're going to discuss each of those. Adjusting the required reserve ratio means reducing the RRR will free up reserves, allowing banks to make more loans. Okay, they have to keep a smaller amount on hand. Reducing it also increases what the money multiplier formula that we went over. And both of these effects lead to a substantial increase in the money supply. Okay, the Fed can also increase the RRR, requiring banks to hold more money in reserve, shrinking the money supply. However, this is not used very often because it can disrupt the banking system, forcing banks to call in loans. And when a bank calls in a loan, you're eroding confidence in that bank. Okay, the Fed can also alter the discount rate. And the discount rate is simply the interest rate that the bank pays the Fed to borrow money. Reducing the discount rate reduces the rate and makes it cheaper for banks to borrow money, which leads to more loans from the Fed and an increase in the money supply. Increasing the discount rate has the opposite effect, and it makes money more expensive to borrow for the banks, leading to fewer loans and a decrease in the money supply. The most important tool, however, that the Fed has for adjusting the money supply is open market operations. Open market operations is the selling of government securities to alter the money supply. Okay. They will do bond purchases in order to increase the money supply. The Federal Bank of New York buys government securities on the open market. And these monies are deposited into the accounts of the bond sellers, thereby increasing the money supply. So when a government security is basically a loan, like a T-bill or a savings bond or something like that, that's paid at a certain rate. And when the government purchases these things, buys them back off of the consumer, and they're traded on the markets, okay, more money enters the consumer's bank accounts, which leads to more money in the money supply. Bond sales, when the Fed sells bonds, it takes money out of the economy. The bond dealers write checks that they give to the Fed, and the Fed processes the checks and money is taken out of circulation. Okay, the goal of monetary policy is what is known as macroeconomic stabilization, okay, to keep a stable money supply so that we don't have wild fluctuations in the economy. Monetarism is the belief that the money supply is the most important factor in macroeconomic performance. The money supply and interest rates, the market for money works basically in the same way that the principles of supply and demand work in all other markets. Okay, the price of money, which is the interest rate, is high when money supply is low, and it is low when the money supply is large. Okay, so you can look at the supply of money in a supply and demand point of view. Interest rates and spending. The government can implement what is called an easy money policy. This policy is adopted by the Fed to increase the money supply, lowering interest rates and increasing spending. And this causes the economy to expand. Or they can do a tight money policy, which is adopted to decrease the money supply by raising interest rates and decreasing spending. And just as with financial policies or fiscal policies, monetary policies also suffer from the problem of timing. Good timing of a monetary policy change will minimize inflation at the peak of the business cycle, and it will it'll minimize the effects of a recession in the trough of the business cycle. Bad timing, however, if a stabilization policy is not properly timed, it can actually make the current business cycle worse, make it more extreme, push inflation higher, create more joblessness, etc. Okay, and poor timing is referred to in the terminology of policy lags. Now, policy lag is a problem experienced in the timing of a macroeconomic policy. There are two basic types of policy lags. One is an inside lag, and this is delay in implementing the monetary policy. And this is often caused by the amount of time it takes to identify a shift in the business cycle. And there is the outside lag, and this is the time it takes in order to get the policy, for the policy to take effect once it is enacted. Okay. It is important in all of this to try to anticipate the business cycle. The Federal Reserve must not only react to current trends, but also anticipate changes in the economy. And this is not the easiest thing to do. Monetary policy has an impact on inflation. Expansionary policies, if they are enacted at the wrong time, can push inflation even higher. And if the current phase of the business cycle is anticipated to be short, policymakers will often let the cycle fix itself. Okay, if they're anticipating a very brief recession or a small dip in the economy, they'll probably just let it self-correct. However, if the recession is expected to last for years, most economists will favor a more active monetary policy, okay, to have some influence on the markets. Okay, so economists will often disagree about how long it takes an economy to self-correct. Estimates vary from 2 to 6 years. 6 years is a long time, and most people are not patient enough to wait that long. And since the economy may take a long time to recover on its own, there is time for policymakers to guide the economy back to stable levels of output and prices. Okay, so if it's a short period of time, they'll probably ignore it, but if it looks like it's going to be prolonged, they'll have time to study it and implement a policy and probably have appropriate timing to do so. Okay, that pretty much covers our introduction to monetary policy. Thank you for attending, and I look forward to talking with you in the future. Have a good day.